You can become so profitable prop firms want to ban you by following these 5 steps. It's how I went full time and how dozens of traders went from losing to payouts. And this isn't about making 10% a day or some secret strategy, but missing one step and you stay the guy funding the whole industry. But before you even think about buying a prop firm account, you need a real measured edge. And most edges die even at the first of 4 walls. Most traders see a few green weeks, a backtest that looks good and buy the challenge. Then a completely normal losing streak hits and they walk away thinking the strategy broke. So before risking a cent, first, you need to calculate your expected value per trade by dividing the net result with the number of trades. Then multiply it with your monthly trade frequency and there is your real edge. Then knock off 20-30%, that's slippage, cost and the mistakes that never show up in backtest but always show up in your account. If the edge is minimum 3 to 5 hours a month, we are good to go. But having an edge doesn't mean anything if you will not be able to follow it. Most traders follow their plan perfectly on demo and assume they are ready. But then the deadline, the max drawdown and real money hit all at once and they can't pull the trigger on the same setups they took all week when there was no pressure. So if you want to save yourself from that, pull up your backtest and do the math on every rule. If I deleted this, what actually changes? Most of the time, nothing. Cut everything that isn't moving the edge, because a system with 10 variables has 3 times more chance to fail than one with 3. But even a simple edge you can follow is worthless if you don't do what comes next. Because most traders demo a strategy for a week, see it works and takes it live. Then they hit a stretch where they just can't seem to execute it. Missed entries, forced trades, a mess that looks nothing like the backtest. 3 weeks in, they are sure the edge broke, but it didn't. They just skipped the one test that would have caught the problem months earlier. 2 months on demo, not to prove the strategy is profitable, because at 20 trades a month, that proves nothing anyway. It's there to answer the question that actually takes them out. Can you run this strategy around a 9 to 5, a family, 6 hours of sleep? On the exact broker you will trade live with real fees and real spread and real slippage. And the last wall is the one that wastes everything you built so far. Because here is what's coming, guaranteed. A month, 2, 3, where you do everything right and the account barely moves. And the trader who has been grinding 2 to 4 hours a day on the charts, look at that flat month, realizes he just worked full time for nothing and jumps to a new strategy, right back to wall 1. So the move is to spend as little time on the charts as you possibly can. Build the whole strategy so a dead month costs you a few minutes a day instead of 100 hours a month. Get all 4 right and you build something the firm's rules can't easily kill. So now you actually buy the challenge. And there are 3 decisions here that almost every trader gets wrong before they place a single trade. If you get one wrong and the account is dead before your edge ever gets a chance. The first one can kill a perfect edge before you place a single trade. Most traders start trading at their prop firms, and their fills come in late, the spread is huge, and the trades that were green on their chart somehow close red. They are sure their edge stopped working. I've been through this as well. I took the exact same trades and copied them across 2 accounts, 2 different firms. On FTMO, it came out to plus 3%, on the other, minus 3%. And that's when it clicked. The cheap firms eat your edge through the execution itself, the fees, the spread, the slippage, and there is nothing in your trading you can do about it. But it gets worse, because even if the shady cost and executions doesn't kill your edge and you are in big profits, you can still lose the account. Your trade goes up to plus 5%. Drift back to break-even, you think nothing about it. But the account is gone, because the drawdown was trading intraday and you didn't even know about it. That's the second way they get you. Not the trades, not the execution, the fine print you agreed to. Which is why you should only use big established names. FTMO, 5% or StopStep. They actually pay and they leave your execution alone. But pick the right firm and you're guaranteed to blow your account before you even start to trade it by making one wrong choice. Because most traders take a strategy that printed all year on demo, finally sit down on the challenge and suddenly snatching tiny profits and freezing on the entries they would normally take without blinking. And no, the solution is not be more disciplined, but they've been told that's it. So they go again, more rules, more willpower, and they crack in the exact same spot. Because none of that was the problem. They simply picked the weight they couldn't carry. When there is more riding on a single trade than your monthly salary, you don't trade your edge, you protect the money. And the fix for that isn't going smaller until it's painless. Because if you fear nothing, you build none of the muscle you will need later. It comes down to one question to find the perfect account size. If I blew this challenge, would it hurt but leave me financially fine? If yes, that's your size. If it wobbles, it's too big. And the last decision is the one that sorts the gamblers from the funded. But almost everyone gets it backwards, because most traders get close, the finish line in sight, and then hand the whole account back on a couple of trades. Then they buy another one and land in the same place. What they got wrong was the level of risk they took to get there, but the right level has nothing to do with your psychology or your strategy. It comes down to one question: are you actually profitable yet? If not, you go methodical, normal risk, repeatable process, because you are not here to pass fast, you are here to learn. I would go aggressive myself, one trade at 5%, pass it or lose it, but only because there is nothing left for me to learn by going slow. And at this point, time costs more than money. Every month a profitable trader is not funded on 100k account is 4 or 5 grand gone. A fixed cost bleeding, and it should scare you. By the way, if you are stuck here, not even sure your edge is ready to face a challenge, that's exactly what we built the free 21-day trading reset for. 3 weeks, we rebuild your foundation, show you exactly where you are stuck, and guide you out of it step by step. So now you got the edge, you bought the challenge, now you need to pass it. And it comes in 2 phases, with a trap buried between them that breaks more good traders than any losing streak. Most people think a 10% target and a 10% drawdown is a fair test. But think about it, when a firm hands you 100k, they are really giving you 10k in equity, and now you have to make 10k without losing it first. That's doubling your account. So when it feels brutally hard, that's because it is. So before you place a trade, do the math. From your EV, your frequency and your risk, you can work out how long passing should actually take. At 5% a month, it's around 3 months to pass both phases and get funded. But you must understand what this number protects you from. If the median is 3 months, then half of the time it runs longer by definition. The trader who has promised 2 weeks blows up his account and changes strategies right when his edge was working. The trader who knows this number sits calm at month 4. And 5% a month on average is really good, no matter what the marketing lies tell you. Then you pass the challenge, and the euphoria hits. And that's the exact moment the trap is set. You take your normal trades on the verification account, hit a normal rough patch, and you are suddenly down 5%, staring at the screen, certain the strategy just died, looking for a new one. But what broke wasn't your strategy, it was your view of it. Because your numbers got reset to 0 when you've been handed the new account. But your edge didn't reset. Count both accounts together and you're still up overall. And the trader who doesn't realize this quits a system that was working perfectly. I watched it happen too many times. With both phases passed, you are funded, which is where it stops being a game. Because the money is finally real, not the $500 you spent on the challenge, not the dream of passing. It's a $2,000 to $4,000 decision on every single trade. That money can be in your hand this week. Or you can slip into a drawdown and lose the whole account. Just be patient and disciplined won't carry you through that. You need actual structures, and I will give you 3 in a minute. But first, you must change your goal. Because the second you start chasing money, you start breaking rules. So for the next 3 months, the only goal is to stay in the game. And everything I will explain in the next 1 minute serves that one goal. A single good trade can swing 4 to 5k on your account, and early on, that much weight on one click makes you close winners too early and freeze on the ones you should take. So until that money feels like nothing in your hands, keep the risk small. That's not playing scared, that's staying alive. But even with perfect risk, the firm can still vanish over a weekend. Or you can break some sketchy rule and wipe a 5k payout you already earned. And the next thing that breaks is your laptop screen when you read the termination notice. Money sitting on the platform is still money at risk, so pull it out as soon as possible. Leave a 2% buffer so your equity ticks up and bank the rest. And the same trap from the last phase comes back. But funded, it's even worse. Someone runs hot through both phases, get 1 to 2 payouts and blows the account a few months later. Then quits sure they failed. When every withdrawal just handed them a fresh account at 0. And across all of them, they are still up. So read the overall number, never account by account, which is the whole reason you bet on the real numbers back in point 1. But the real threat to a funded account was never the market. It's you in a bad moment, and you can't willpower your way past it every single time. So you need to build 3 structures that take the decision out of your hands before the bad moment ever comes. The danger is how easy it is to fire off one more trade. The revenge click after a loss, the board click at 2 PM. So you put friction in the way. Log out after every session, a password somewhere you have to get up and reach. The impulse has to cross an obstacle before it becomes an order. But cutting the bad trades means nothing if you also miss the good ones. And the Discord full of guaranteed longs is the fastest way to talk yourself out of a legit short position. So during your trading window, the noise is muted. Discord, Twitter, Telegram. Nobody in the chat room is funded on your account. The worst moment of all is when the money is moving and every cell in your body says do something. Move the stop, take the profit, add to it. That urge is where funded accounts die. So you don't leave that decision to yourself in the moment. Alerts on your levels, chart closed until one fires, stop loss and take profit set. The second you enter, then walk away. Then your first payout lands. But don't do what most traders do. Don't spend all of it on stupid stuff. And only reinvest maybe 20% into more accounts, because dumping everything back in drops you under the exact pressure you just escaped. If you did all of this, you survived the first 3 months funded. Now the last part, scaling. And this is where most people fail one final time in one of 2 opposite directions. Scale too slow and you will leave huge money on the table for nothing. The pressure of a bigger account is coming either way, so dragging it out just delays the income without removing the fear. Scale too fast and you pile on more pressure than you can hold, and you blow the account you spent months earning. The whole game is the pace between those two. So here is the pace I would actually run. 100 to 200k over 3 to 4 months. That might look slow, but it's a 2x jump and the trade isn't making 4 to 5k anymore. It's 8 to 10k. That's a different game, even with salary landing on top. Then 200 to 300k over 2 to 3 months. Only a 1.5x jump, easier than the first. And you keep going because the target is a 600 to 800k portfolio, but a simple 2 to 3% month is 15 to 20k. And now the part that matters most, because you already know what one firm can do. A rule change, a weekend shutdown, payments put on hold. You scale horizontally, not vertically. You buy 200k accounts across 3 to 4 reliable firms instead of one giant account. If anything happened to one firm, you lost quarter of your capital, not all of it. And the principle we carried the whole way still holds. More capital means more to lose. So the risk per trade comes down a notch at every level. Trading gets safer exactly as it gets larger. But the traders who actually keep scaling don't think like traders. They think like CEOs. So watch this video next. You will learn 6 tactics from the biggest companies on earth applied to trading.